Welcome to your first step of mastering the art of fundamental trading. In this video, we're going to dive deep into macroeconomics, understanding all the key and core components that are driving the assets that you are trading in terms of their value and how that translates on the charts with price movements. Don't worry, I make this super simple for the everyday person to understand, but all of this is key and must not be overlooked if you want to really level up your trading game. To add to this excitement, I'm going to be giving away 3 funded SFT challenges. So what I want you to do is make sure you comment below this video of why you're excited to learn about fundamentals. Make sure you hit that subscribe button and give this video a like. Without further ado, I hope you're ready, have your notebooks at hand, and let's jump straight into this. So what exactly are macroeconomics and fundamentals? Well, we're looking at the economic performance as a whole. Imagine being in a helicopter and you have that view over the economy. We're not focusing on just one individual or one singular business. We're looking at the general bigger picture of the economy. Now, when we're looking at things, we want to understand, are we seeing a decent amount of growth? Is the economy in expansionary territory where we're growing, things are looking amazing? Or are we in contraction territory where the economy is shrinking, things aren't in a great place? We also want to understand the labor force, because the labor force makes a big part of the economy. Do we have a decent amount of jobs being added? Is the unemployment rate low? Are wages high? And then, of course, we want to look at inflation. At what rate are prices of goods and services rising? Because if they're rising, typically speaking, we have a hot economy, an economy that's solid because people are out spending their money. So of course, prices of goods and services are going to rise. Or are we in a period of where inflation is falling and instead we're getting deflation, where prices are coming down in an economy which isn't so sound? And we also want to understand, of course, the retail sales. Retail sales is general consumer spending. Are consumers out spending their money, stimulating the economy? There's a host of things that are really important to understand and put a value on an economy. And then, of course, it's relating assets such as the stock market, or it's relating currency. If we're looking at the UK economy, we want to understand how growth is, how the economy is performing, because that puts a value on the pound versus its peers. So there's a number of things to look at, which we're going to dive deep into this video in further detail. Now, before we progress further in this video, what I've done for you is I've created a free ebook which goes into detail of all the points that we have covered today, so you can refer back to once you finish watching this video. Now, what you need to do is join the Discord, the Fundamental Trading Club Discord, via the link in this description. Key indicators and their relevance. Now, we touched upon some of the core components that make up of that bigger picture of the economy, but let's dive into those in a little bit more detail, starting off with number 1, GDP, which is gross domestic product. When we're looking at GDP, it's giving us an idea of how the economy is performing as a whole. Are we seeing that growth, an expansionary economy? That means positive numbers, and we can get GDP readings on a month-on-month, quarter-on-quarter, or year-on-year basis. Or do we have negative readings, minus, which means the economy is contracting? Now, when we have back-to-back negative numbers, that means we have a potential recession, a technical recession for an economy. Now, it's really important that we look at GDP, because if, for example, we have such as the latter that I just mentioned, where we get back-to-back negative readings, contractions, a technical recession, this is going to decrease the value of assets in that relating economy. So if, for example, the UK is in a technical recession in comparison to its peers, then the value of the indices, stocks, are going to come down. The value of the pound potentially also going to come down relative to its peers, and that will turn off foreign investment. Now, remember as well, with economies, foreign investment coming into an economy makes a big part of potentially trying to boost things, okay? Trying to boost output. Economies rely heavily on foreign investment coming in, so never neglect GDP readings. Number 2, inflation. So this is the rate of which prices of goods and services are rising. So when we have an economy that's running hot, people, of course, are out shopping, spending their money. Now, with all these people out shopping and spending their money, what do you think these businesses that are offering these goods and services doing? Because there's such high demand, they're going to be putting up their prices. So when we have a lot of spending going on, a good and healthy and happy consumer, prices of goods and services are typically on the rise. That we have a heating economy. To get an idea of where inflation's at in an economy, we must look at the such as CPI, which is Consumer Price Index. This gives us an idea of general prices of goods and services for everyday consumption, such as your general food, energy bills, all of that. And then we have PPIs, which is Producers Prices Index. Now, with the PPIs, these are the costs for the producers of the goods and services that are going out to the consumers. So are their prices rising? Because of course, if their prices are rising, they're going to be passing that on to the consumer as well. And then it's going to be contributing to overall inflation rising in an economy. Now, we have inflation, but then we also have deflation, where prices of goods and services are falling so drastically, where consumers are not outspending. Consumers are reluctant. They're sitting on their hands, perhaps because the labor market isn't great, wages are low. And if people are reluctant to spend money, then of course this isn't stimulating the economy. So prices are going down, and potentially we could have deflation, negative prices where they just continue to fall because we have not got a bustling and a warm economy. We've got actually a cool economy. Now, with all of that decreased stimulation because people aren't outspending and those prices are coming down, what we could have is contraction in growth, negative growth, as I explained before, with recession. Now, where we have low growth and also low prices, that is a really bad place to be for an economy. Japan historically suffered with that, where they had deflation and they were trying to bring up inflationary levels because consumers were just reluctant to want to spend their money. Number 3, the labor market. Now, there's various components that we observe on this front, starting off with employment change or jobs being added to the economy. If we've got a decent amount of employment change, a plus figure, a positive one where jobs are being added, this is a very encouraging sign. This is great for an economy because it means we have more potential people coming into the labor force. It means more people are out stimulating for these businesses, stimulating as a whole for the economy. And then we will also want to look at the unemployment rate. We want, typically speaking, for a sound economy, for the unemployment rate to be low. Less people unemployed, less people claiming unemployment benefits, and that means more people that are in the workforce, again, stimulating the economy. We also want to look at earnings, wages. What are people actually getting paid for all this work that they're doing? Because if people are getting paid more money and wages are on the rise, they have more disposable income to go out and shop. Consumer spending, spend, stimulate the economy, help it grow, the overall output. And of course, with all that spending going on, as we mentioned before, with inflation, prices of goods and services are on a rise. So if we have a bustling labor market, again, this is great for the relating currency and great for indices as well. And number 4, retail sales and consumer spending. With retail sales, it gives us an indication of how retailers are performing. And this is important at the end of the day because it goes back to the consumer again. If we have a healthy economic environment, we have a confident consumer, we have people that are getting paid decent money, people are going to be out spending. Okay, they're going to be spending. This is great for the retailers. Their sales are going up because the consumer's happy, the consumer's healthy, and we have a bustling economy. Now, with all these key economic indicators, it's really important that we don't just focus on one area. Remember I mentioned at the start of the video, helicopter view. View the bigger picture. We want to understand all those key components across GDP, inflation, the labor market, retail sales, so that we can have a view as to whether the relating assets such as the currency or the indices are going to be on the rise or falling. One thing that helped me with this in my early days was I had a spreadsheet. Now, for you, again, this is going to be in the Discord, so check the link in its description to join the Fundamental Trading Club, and this resource will be there for you. Essentially, you have a spreadsheet where, for example, you can have one column for the pound, one column for the dollar, for euro, Aussie, NZD, CAD, so on and so forth, whatever currencies you want. Now, in the columns as well, we're going to have the economies relating GDP. We're going to have their labor market figures, what a central bank is doing, which we're going to get onto, retail sales, inflation, all of this, so that we can form a bigger view of how one economy is performing versus the other. Because, of course, that difference is going to create a big gap when we're trading, right? Whether it's trading GBP versus dollar, whether we're trading euro versus the dollar. So we're looking at the bigger picture so that we can formulate a view on where the assets are going to be moving. Interest rates and central bank policies. What exactly is a central bank and their role? Well, a central bank is a ruling authority of an economy. They will have the goal and mandate of ensuring economic and price stability. So they will conduct monetary policy action on the back of how an economy is performing. So let's start off with interest rates. If we have an economy that is growing, we're seeing decent growth, strong labor market, good consumer spending, inflation is on the rise. Typically speaking, in this environment, we will have higher interest rates. Now, with higher interest rates, that typically means that the relating currencies, so say for example, in the United States, we have what's known as the Federal Reserve. They are the central bank of the United States. If inflation is on the rise, rising because we're seeing decent growth, people are out spending their money, they will then need to have a higher interest rate environment. The reason being is when we have higher interest rates, we're also going to be potentially trying to cool down inflation because we don't want inflation running too high because that causes a problem for the economy. Then it means people's affordability is going to start to diminish if prices of goods and services are rising too fast. So then the central bank will raise interest rates because remember, when we're raising interest rates, we're raising the costs of the general consumer. So for example, on our mortgages, on our loans, any outstanding credit card balances, the interest that's paid on that debt rises. So then as a consumer, we're going to be more reluctant to want to spend our money. Okay, we're not going to want to spend so much. So naturally, if we're spending less, that means inflation should start to come down. Prices of goods and services should start to come down, tying in with less consumer spending. In environments of higher interest rates, this is bullish for a relating currency. Why? Because it attracts foreign investment. Remember, it's the interest that foreign investors earn. So if we have an economy or a central bank, such as the Federal Reserve in the United States, they're raising rates to try and cool down inflation or raising rates in an environment of a heating economy, an economy that's overheating, it's going to attract foreign investment coming in because these foreign investors are seeking the highest interest that they can earn on their investments, the highest yield. So that's going to attract foreign investment coming in. And then how do we actually invest in that economy? As I've given with the example with the Federal Reserve, we need dollars. So they may be a foreign investor in Japan or in Europe or in the UK. They will need to sell their relating currency. So we'll see weakness and demand for that currency and then inflows into the United States. They have to exchange their currency into dollars so the demand for dollar will pick up. On the other hand, if we have an economy that isn't performing so well, we have low growth, labor market isn't great, inflation's coming down, then the central bank will look to take action in the form of cutting interest rates. So when they're cutting interest rates, remember, they're going to be lowering the costs for us. They're going to be lowering the costs, the interest that we are paying on our outstanding debt, mortgages, credit cards, loans, all of that, to try and free up some more cash for the consumer so that the consumer will want to go out and try and spend and try and stimulate the economy again to try and prevent it from further contracting. Because if we go out and we start spending our money again, we're going to be stimulating the economy, and then eventually that inflation that's been falling, that contraction that's been happening in the economy should start to pick up some pace again as the central bank has then lowered our costs. But on the flip side, remember, this will turn off foreign investment potentially. So if a central bank is slashing interest rates, we could see weakness in that relating currency because foreign investors will then start to take their money out. We'll see an unwinding of them initially coming in to invest in the economy, unwinding and trying to go and seek where central banks are keeping their rates higher. Another action that a central bank takes in times of an economy isn't performing so well is what's known as quantitative easing. So they are effectively trying to print money, pump money into the economy to try and stimulate things again. Now, they can do this through various operations where we do have that economic downturn, we could get a credit crunch. Essentially, a credit crunch is where lenders are reluctant to want to lend money because of this faltering environment. They don't want to go and give out money to consumers in case they don't get it back. So what a central bank does is they conduct these operations where they effectively encourage the banks to lend. They say, look, take this money. We're giving you this facility. We don't expect you to rush to pay us back. We don't expect you to pay us high interest on this. This is effectively free money for you to go and obviously then charge a small interest to the consumer so that the consumer then goes and borrows from that financial institution. And then what do you think the consumer then does with that money that they've borrowed? They then go and spend. And they go and spend, try and stimulate the economy. Now, when a central bank is conducting that action, yes, it is good for the economy in the run to come. But initially, we may see weakness in that relating currency because remember, we are effectively flooding the markets with, say, the case of the Federal Reserve conducting this quantitative easing. We're effectively printing money and flooding the markets with dollars. So if we have all that flooding of the market with dollars, imagine we have so much of a float of something, so much of something building up, the value of it's going to come down. It's diluting the value of the currency. So keep that in your mind as well when a central bank is conducting quantitative easing. Now, before we progress further this video, I hope you're all taking thorough notes because fundamentals are extremely vast, but they can be conquered and they will level up the entirety of your trading game. Now, obviously, I am stuck within time constraints of this video. So what I have, if you check the link in this description, I have a full in-depth fundamental course where I break everything down. It's extremely simplified and it's going to help you be able to translate this information on the charts and what it all means. We've got various strategies in there of trading fundamentals with technicals. It has amazing reviews from the community. So if you're interested in really going into a serious amount of detail, simplified but effective, you can check that link in this description. Geopolitical events and financial and economic crisis. Now, there are times when these events occur and they can have big impacts on the markets. Let's start off with geopolitical. We have seen in the past where Russia invaded Ukraine. This sparked a war between Russia and Ukraine. Now, with war and geopolitical tension brings uncertainty to the financial markets. Now, when we have uncertainty, markets are less inclined, investors are less inclined to want to invest in riskier assets such as stocks. So we will typically see the stock market selling off in times of war, and instead flights into safe havens. So money flows into safe haven assets such as gold. Gold is deemed a safe haven asset, a safe haven commodity where people put their money in times of uncertainty, whether that be geopolitical or whether that be a financial and economic crisis. It's seen as a safe haven because it holds value during market turbulence. And then we have safe haven currencies, your likes of your Japanese yen. The reason why that's a safe haven currency because Japan has been sort of economically and politically stable for many years. Nothing too drastic happening as such for Japan. So the JPY has been one to put your money into in times of uncertainty. You see JPY strengthening during geopolitical tensions or financial economic crisis. Same as the Swiss franc. The Switzerland is a stable economy and has been so for many years. And of course, the US dollar. The US dollar at the end of the day is attached to the largest economy in the world. It is the reserve currency of the world and is also a safe haven. So during these periods, we will see flights into safe havens and weakness into riskier assets. When it comes to a financial and economic crisis where essentially we've had these huge economic downturns, economies are crashing essentially, financial institutions are crashing, consumers are losing jobs, out of work, there's just no stimulation happening or stimulating of an economy, we've got a potential recession, and this is where we refer back to central banks needing to step in and take action in these environments, like slashing rates and pumping money into the economy to try and stimulate things again. We saw it with the pandemic, with COVID, where this pandemic forced economic shutdowns completely. Borders were closed. Logistically, things were just not happening. Everything was just at a massive standstill. So this was affecting not just individual countries, but on a global level, this was impacting economic growth and causing large contractions where we were seeing these massive downturns in economies, and central banks were having to really ramp up their efforts to try and prop the economies up again. Now, it's really important that we take note of signs of a financial crisis or an economic crisis because we need to be aware of how we're going to position ourselves. Are we going to be looking to capitalize on that in the front of shorting indices because during those periods, indices are getting hit hard as a riskier assets? Or are we going to be putting our bets and our trade ideas into gold because gold should start trending to the upside on the back of these events and these crises or general safe havens as well? Commodity markets such as gold and oil, they are largely influenced by the overall economy. Let's take a look at gold, for example. We mentioned earlier how gold is deemed as a safe haven. It benefits and thrives in times of uncertainties with geopolitical tensions, financial crisis, economic crisis, but it's also a great beneficiary of inflation. If inflation is rising drastically of prices of goods and services globally across the board, gold is a great hedge against inflation. Why? Because where we have inflation and prices of goods and services rising so drastically for any given economy, say for example in the United States, your dollar doesn't go as far as it should because prices of goods and services are rising so much. So your dollar doesn't go as far. It loses that value in essence because these costs of these goods and services are high. So gold is a good hedge against that currency erosion. So during those periods, people will put their money into gold as a safe haven, as a hedge against those periods of high inflation. Oil. Now, there are a lot of components that make up of the oil market, but let's look at some of the key points. Firstly, with oil is extremely sensitive to global economy, how well it's doing, because if an economy or economies in general are not doing well, the demand for oil tends to come down, okay? The demand for oil comes down and then prices also fall. We saw, for example, in the pandemic during COVID, it's also very important, just before I get onto this point, to look at which countries, which economies are huge consumers of oil, okay? Who are massive oil importers? So going back to my point, with COVID, where we had the economic shutdowns, and remember, COVID was reported started off in China. China are the world's largest oil importer. They're a heavy consumer of oil. So when China shut down, what do you think happened to the oil market? What do you think happened to oil prices? Oil prices fell. Actually, they crashed. We saw huge selling for the oil market because essentially China shut down their borders. Logistically, people were not moving. The economy wasn't moving. So there was less demand for one of the world's huge oil importer. So prices fell. So oil is extremely sensitive to economic conditions. If we are in a period of economic downturn, typically speaking, we should see oil prices fall. If we're in a period of economic growth, demand for oil should be higher, so prices will rise. And just to round off on oil, it's important to note the correlating currencies with the oil market. For example, we have Canada. Canada are a major oil exporter. So a lot of Canada's income, their revenue comes from oil sales. So if, for example, we have oil market is in a great place, oil prices are rising, that is good for the Canadian economy. That is good for Canada. So essentially, we have more income for Canada and the value of the Canadian dollar should rise. But on the flip side, if the oil market is in a downturn, demand isn't great, prices are falling, then that's going to have a potentially negative impact on the Canadian dollar. So watch that correlation as well with oil and other commodity-linked currencies. Putting it all together to develop a macro-inspired strategy. Now, we've gone over a lot of the key concepts that make up fundamental analysis, understanding all those key economic data points so that you can formulate a view, the helicopter view, on an economy as a whole, because that's going to dictate the value of the relating assets, whether that be the currency or the stock markets. And then, of course, depending on how the economy is performing, a central bank is going to be conducting necessary actions to ensure economic and price stability. So with all of these, they provide opportunities. When you refer back to, as I mentioned before, about that spreadsheet, remember, link in the description to join the Discord to gain access to full ebook, PDF, and the spreadsheet to help you analyze fundamentals. But remember, we're formulating a view. So if we're looking at GBP versus the dollar, we're understanding economically, how is the UK performing? How is that going to influence the pound? And then the same thing for the dollar. How is the United States performing economically? And you're weighing them both up. We want to see if we have an economic divergence and, of course, also a monetary policy divergence. Because if the Bank of England are in a period of raising rates and the FOMC are not, they're keeping rates unchanged, or if anything, are looking to lower rates first before the Bank of England, there's a monetary policy divergence. So that will create an opportunity for you. That will create what's known as a fundamental theme, interest rate differentials there, because it will give the pound the edge over the dollar economically and on a monetary policy level. And that presents opportunities, that presents trends in the market. So if you're in line with such trends like this, right, where we have economic and monetary policy divergences, you can incorporate that into your trading strategy. Now, there's various strategies that you can trade fundamentals with. I go into serious detail in my in-depth fundamental course, so the link in the description. I like to trade supply and demand, particularly one of my main strategies with fundamentals. I'm looking at those key zones, marking up those big zones where we're looking for buyers to come into play, demand zones, and also supply zones where we're looking those sellers to come into play. So I'm looking, if we're in a trending market, I've got my fundamental trend for whatever reason, my fundamental theme. I'm then also looking to tie that in with the supply and demand zone. If we've got a fundamental theme that's driving GBP dollar as an example to the upside, then I'm looking at my zones to see how we're going to be working zone to zone to the upside there for my entry. So my fundamentals give me the view, give me a strong bias of where GBP should be going versus the dollar. And then my technicals give me my entry, okay? So there's a lot to cover there. As I said, we're in time constraints, but there is an in-depth course. As a reminder, make sure that you comment below this video, you hit that subscribe button and the like button to be entered into a chance to win one of 3 funded challenges of SFT. Other than that, I hope you enjoyed that video. Make sure you do join the community below, the Discord community, the Fundamental Trading Club. Stay lit, stay blessed. Let's get it.